obviously, if they invested with you in the past, it becomes a lot easier because you have a track record. They've obviously you've been successful. You've returned money to them, and they're gonna come back to you no problem. Given the climate is right, the economic climate is right, their financial climate, finances are right to go back into the deal. So exactly, it's the personal relationship that is very important, and that's why we provide those. Every deal we put on the site, we offer a video webinar which goes on the sponsor's deal page.
Welcome to the Bulletproof Cashflow podcast. Let's get into the show.
Hey everyone, it's Agostino. When it comes to scaling your real estate business, crowdfunding can be a powerful tool for any operator. In fact, it is the preferred methods for many investors out there that help build their portfolio. Well, today's guest understands this method very, very well. Now, back in 2008, after he finished his residency and started working as a medical doctor, he also got started buying distressed single-family properties and renting them out. Now, as the market recovered, he converted many of these single-family holdings into multifamily. Now, at the same time, he was introduced to real estate syndications, and he just ran with it. Now, a short time afterwards, he created Park Place Investments with the mission to help investors get into the real estate crowdfunding game. Now, with all that, I'd like to welcome Kam Zainabadi to the show. Hey, Kam, thanks for coming on.
Thank you. Thanks for having me, Agostino. It's my pleasure to be here and telling you about my venture, Park Place.
Yeah, well, in the green room, very excited to talk to you about it. So I can't wait to share it with the audience. Now, if you like what Kam has to say through this interview, please reach out to him via his contact page at parkplaceinvestments.com. If you like our content, please don't forget to leave a comment and rate the show. Finally, if you text the word freedom to 202-410-4202, you get our free ebook, The Bulletproof Guide to Raising Capital. Okay, Kam, go ahead and tell listeners a little bit about your start in real estate and some of the struggles you came up with back in 2008.
Sure, I would love to. In 2008, as you know, that was a really bad time for real estate and everything. The market was crashing. I was kind of in a perfect time and place because I was starting to have some cash flow through my profession, and I had some money to invest. And I was in the Inland Empire in California, which really, as most people know, took a really big hit, and markets were down 60-70%. There was a lot of distressed property. So, and back then I knew that it's below the cost to build these homes, and every block had 10, 12 homes that were on sale. So I started picking up those properties and renting them out. And as you know, people need a place to live, and when they lose their home, they have to rent somewhere out and live. So that's what I was doing, and I let the market recover, and then through 1031 exchanges, I sold a lot of them and got into multifamily. I moved them more towards the coast in Orange County area. For example, Anaheim is a great place. It's Disneyland. There's a lot of businesses there. It's a tourist town. It's an industry town. So I started through 1031 exchanges converting a lot of these single families to multifamilies. And at the same time, as I got to know the real estate business, I got introduced to syndications, because one of the barriers I've had is I got to know residential market and multifamily to a small scale. But as you know, especially in California, the cap rates are a lot lower than some of the secondary and tertiary markets. So so either you have to go outside of your geographic location and comfort zone, and go into different asset classes like commercial. So I kind of had a difficult time getting over that comfort zone. So when I got introduced to syndications through my network, I said, well, heck, this is a really good way to start and become a passive investor in some of these larger deals, which I don't have access to. Some of these deals were, $40-50 million deals, which, as a individual, it's very hard to, not in the commercial business full time, was a hard time for me to, do that. So, and I had success with syndications, and since then I've been moving my portfolio more and more towards becoming a passive investor. And then I got into crowdfunding through some of these, again, it was a progressive evolution of my financial life cycle. I got into crowdfunding a few years ago, and that was successful. At the same time, I was doing angel investing in Silicon Valley funds and startups, and kind of strengthened my network both in the real estate and in the tech industry. And then that's how I made the jump. It wasn't really a leap at that point. It was more of a small jump into heck. Let's see where the gap in the market is, where we could add value to the to our colleagues and sponsors and both investors also. And that's where Park Place idea was born. It was born less than a year ago, and it got launched about a month ago, and it's just been a runaway success as far as some of the metrics that we had to get to are kind of like we're blowing away through those.
Nice. So before we get too far down the road here, maybe you can give an overview for those who aren't familiar. What is real estate crowdfunding? Because we talked a little bit in the green room, as I mentioned earlier, and it is slightly different. Your model is slightly different than just regular old syndication, right? So maybe you can go into what you do, the overview.
Sure. I mean, both syndications and crowdfunding are kind of a vague definitions, but I just want to go back, take a step back. And syndication is when, in general term, is when you want to raise equity and you go to, your investors and they put some money in through it, becoming a limited partner. Well, crowdfunding is a type of syndication, I would say, because instead of going to your network of your own investors that you've established relationships, you go to the crowd or you go to a larger group of investors and you expand that. So I think it's kind of a continuation of the same definition. So most crowdfunding deals are syndicated deals by definition. However, they allow general solicitation, which that means is basically general solicitation is when you could go beyond your network of investors. And this is really kind of a hard stop with SEC and FINRA, that they really were really against general solicitation for the longest time. And really Jobs Act, which was kind of a byproduct of all the problems, the previous recession, was that allowed certain types of general solicitation to occur. And those have to be through an exemption, either Reg A, Reg D, or Reg crowdfunding. So crowdfunding, so that kind of started the birth of the crowdfunding. And companies started listing syndicated deals and going to the general population or a credit investor population to try to raise money through that way.
Okay, well, good. So now you mentioned the SEC regulation pertaining to the general solicitation. So I know you talked about Reg A as well. So how does that differ then from the crowdfunding? From crowdfunding then, because obviously when we're syndicating our deals, we're raising money from friends, family, primarily. A lot of those guys, a lot of previous investors that really believe in what we're doing, very happy with the returns. They'll throw down another 100 or 200 or whatever money. But what you're doing is slightly different, though, right? It's very different.
Yeah, I mean, crowdfunding. If you first of all, the amount of raise per investors usually lower. So I'm not sure what your minimum was. Some syndications have a really high bar, like 250K. Some go down to 50K. As you go to the retail investors, or if you don't go towards credit investors, you kind of you even set the bar lower for the like 10K or even 5K. So I mean, I think that's part of the definition is you're raising money through multiple people with a lower cap, a lower amount of how much each person could raise. So it's not a good model for every syndication or every developer, because if you're comfortable with, you have a pool of investors and that you could always go to them, or you have institutional money and it's always there, certainly then there's no need to go to crowdfunding. However, a lot of syndications, especially those in the middle, those that want to raise less, like 10 million or less. Well, a lot of times they can't go to institution money. They're not going to, so it's really for the middle of the road. It was initially for more of the middle of the road syndications, or people that were just like, hey, let's give it a try, right? I mean, a lot of the syndication said, hey, I want to try it. So there's some of the first movers. Those were really initially what they were for mostly, but it's accepting, it's becoming more accepted. Then a lot of the larger syndications are actually jumping on board, but it has to be part of your model. I mean, if somebody's happy doing what they're doing, then certainly you don't need to be crowdfunding.
Right.
Yeah, but always, who doesn't need more capital? Who doesn't need more money?
Well,
Yeah,
well, exactly right. Yeah, that's right. There's
yeah,
never a shortage of that. We
yeah,
can always find a deal to throw that cash in, right?
yeah. And a lot of times it could be part of your capital stack, right?
Yeah.
It could be, so you don't have to be exclusively crowdfunding when you're trying to raise money for a deal. You could be part of it.
Right. And so now how does what you're doing then differ from like a Fundrise or a some of these other
Sure,
REITs out there, these
sure.
crowdfunding REITs, yeah, like CrowdStreet, those types of guys.
Yeah, absolutely. So I divided the crowdfunding space into um, three different sections. One is purely people that are purely going towards retail investors. With retail investors, those are non-accredited investors, smaller mom and pop. Just you don't need to be making over 200K or have assets more than $1 million. So those you have to go either Reg A or Reg CF. So Reg A is very difficult to get. It's very laborious, and some of the larger crowdfunding sites have gone that way. So Reg A. Some of the other crowdfunding sites are crowdfunding exemption. So those are typically not only used for real estate, but also used for angel investing, Kickstarter, and all these guys. So it's kind of a vague model to raise capital. It doesn't have to be for real estate, but companies use that, and they go towards retail investors. They had to raise smaller amounts because the cap for crowdfunding exemption has been 1 million. So you can't really, if you want to raise 7, 10, 20 million, you couldn't do that. However, SEC is broadening the amount of raise to 5 million in a couple of months. So they've already passed the ruling. It's going to go effect in a couple of months. So it's actually going to be a larger cap you could raise. So that's the second type of crowdfunding sites. I don't want to name particular names because I don't want to get into trouble. They calling me and telling me, hey, this is not how we're doing it, or purely. But so I'm just saying kind of broadly using general terms. So one is Reg A, one is Reg crowdfunding, and the third one is Reg 506C, and that's a lot of crowdfunding sites using that. And those are when you list usually another syndicate, like you're using a syndication, not your own deal, but somebody else's, and you're putting it on your site. So those are kind of the three broad crowdfunding structures there is. And then the other structure is either debt or equity, and also whether you're listing somebody else's deal or you're doing a fund model yourself. So those are all the different kind of ways you could kind of branch out what crowdfunding sites do. Ours is a little bit different because we are helping sponsors and investors connect. So we are not listing our own deals. We're not a syndication. We're almost like a marketplace or platform. Our mission is become an MLS of all the general solicitation syndicated deals in the US. So we want to create a value both for the sponsor side and for the investor. So ours is very different than the other models that I mentioned.
Yes, absolutely. Because just to give clarification to the people out there, when we're going off and raising money in our regular old syndication, we're typically buying B and C class assets for the most part. And we're going to buy the asset, renovate it, make it better, bang up the rents, do a refi in 5 years, sell it off in 10. That's pretty much the cookie cutter methodology that many syndicators out there do. Yeah. We go and raise money from our friends, our family, previous investors. They throw down their money, and that's generally how it works. But what you're doing is slightly different. To your point, it's more like a connection service, right? So I would have to, you and I would connect. Maybe there's a website. I throw the deal up there on the website, and then it sounds to me like you're getting out there and you're networking it. I'm sorry, you're marketing it rather to your audience, and then they might log in and look at the team or whatever that's behind the deal and make a decision whether they want to invest or not. Is that accurate?
Yeah, so if you think about it, there's several parties that are interested within this platform, right? There's the sponsors that, listen, I want to get my deal out there. I'm doing my own marketing. I have my own private equity, institutional investors, let's say for the bigger guys. But you know what? Hey, this is an opportunity. I want to broaden my investor. Let me put it on the site, okay? And it's very easy to put on the site. It's free for you, and you put it out there, right? The second party is, and I've been approached with several private equity firms that are looking for deals. They want to invest. They want to. So they come on the site and they look at these deals and go, "Well, this one's a pretty nice, pretty nice deal. Let me talk to the sponsor, see what it is. Maybe they didn't know about this sponsor." And the third one is actually the accredited investors or the retail investors that they want to go on the site and they want to, going back to personalizing it myself, that, hey, I want to invest somewhere in, let's say, South Carolina. I've heard, it's becoming a really big capital of tech, or things are moving out of, as you know now with this, what's going on with COVID is people are moving out of New York or LA or primary markets, and secondary and tertiary markets are becoming hot because of the Zoom economy. So, but I don't know much about those markets, but I want to invest and get into the action. But I'm a professional. I don't want to really deal with a leaking roof or a plumbing problem, right? So I want to get into commercial, right? So that's those are the investors that looking for passive income, get into commercial, headache free, and those are the ones that the third party that's involved.
Nice.
And then to broaden that up is now then you got the lenders, you got the lenders that want to get in a piece of the action. There's deals on the site, and they want to, hey, I want to provide my services to a sponsor. And so those are the other real estate professionals that would benefit from the site. So I think it really, I think it would add value to multiple parties within the industry.
Okay, so are you vetting out those folks, I guess the sponsors for those deals? Like, are you vetting them out, or are you also vetting out the people that may want to invest in these deals as well, or is it just open?
Well, yeah, I mean, as far as the definition of vetting, we certainly have certain criteria for sponsors to list a deal. We have an investment committee, and we go over the deals. But that's a lot less stringent than like some other sites that list deals, because those vetting process could be 6 months. For us, sure. For us, within a week, we basically, let's say you show interest to putting something on the site, you could list your deal on the site, but it'll go live after we at least take the investment company looks at the deal, and then we make it go live, and it's a lot quicker. And then. As far as vetting the accredited investor is concerned, we have a form that they have to fill out to become an accredited investor. So you could log into the site and become a member, but you have to fill out a certain, go through a certain form and process to become an accredited investor. You either have to show a certificate from your CPA or attorney, or we have a third-party service that does the accredited investor certification for us, so you could go through them. But if you don't have those, then unfortunately you can't really participate in the process as much.
Right.
As far as whether we're kind of approaching sponsors to list their deals or vice versa, or they're approaching us, well, as we started, approaching sponsors, but now sponsors are finding us. So, we want to expand our network of sponsors to list their deal and kind of really become a listing platform for most of the deals in the U.S. on it. And I think it's a very doable thing, because I think from a sponsor standpoint, it's kind of a no-brainer. Why not list it and open it up to your pool to more accredited investors or institutional money?
Absolutely. No, absolutely. So I guess the one thing we probably have to clarify though is, what's your cut then? Like, what do you guys get when you're brokering this thing? How does it work on your perspective then?
So So there's several levels to that answer. One is we're not trying to be cash flow positive right now. So, we have enough money. We're funding it. We want to grow our base. We want to create a value. And that's number one. So we're not going to charge any of the sponsors any fees right now to list their deal. They're as much value to us as we're value to them. Okay, that's number one. So we have no listing fee. All our services are free of charge to sponsors because honestly, they're adding as much value to us as we are to them. I mean, we love to have great deals on our site because that attracts investors, that builds a community. That's number one. Number two is you have to look at certain things we could do that are within the realm of SEC and FINRA or not. If you're not a broker dealer, it's very difficult to get commission. I mean,
Right.
you have to be within the legal thing. Although they're loosening their criteria. I just read an article yesterday, and they're for non-dealer brokers, they're going to be able to charge commission. Again, that's something we have to revisit our model and maybe charge commission. But right now, again, we don't want to charge any commission for the deals. We don't really need to right now. We're not trying to, we're not greedy right now. We shouldn't be. As a startup, you want to create value.
Absolutely.
Facebook wasn't cash flow positive, or Amazon wasn't cash flow positive till last few years ago. So
yeah,
those are
that's
we
right.
want to build a community. I mean, we were doing it the right way. We're not spending millions of dollars and being in the red. That's not our model. Our model is to bring everybody together, create value, and I think we'll be rewarded. As far as what I envision, the way we would monetize is, number one, if we reach an X amount of credit investors and there's a lot of site traffic, we could charge a listing fee for the sponsors in the future. And it's not going to be $50,000. No way. We don't want to do that because that's something we're going against. We don't want sponsors to spend that much money either through broker dealers, commissions, or through crowdfunding sites. It's going to be a lot less money to list the service. And then we have additional ways to monetize it through, getting more eye traffic. And those are things we could certainly do, and more kind of like a marketing service as opposed to a financial service or commission based. So.
Interesting. Here's an interesting thing for you. As far as using the platform for syndications, what if I wanted to use it as a way to pick up some hard money from investors, right? So they can invest it in basically in a note. Is your system able to do that? I'm just asking you off the cuff. I mean,
no, yeah. You're talking about distress. I mean, yes. As a matter of fact, we may list it as a note as long as it's 506C. If it's a 506, I mean, anytime you list securities and you go through general solicitation, you have to get an exemption. That's just basically SEC is nothing. It's not a rule that we're setting. It's just the way it is.
Right.
And if notes are a form of security, then if you're trying to reach out to a larger group of investors, you have to get some type of exemption. And typically, the one usually sponsors get is 506C, which is just a step up from 506B.
Right.
The CF exemption is a little bit different because you with CF exemption you have to list your deal in a funding portal. So it's because whenever you go to retail investors, there's a little bit more rules and regulations. So CF exemption is a little bit different. You can't really list it on your own site. So it's a little bit different. But anyways, the short answer is yes. As long as it's 506C, you could list any securities you want on our site.
Nice.
As long as it's real estate.
Now, how many investors are currently logging into your portal every day? Like, is it you got a lot of activity so far?
We have 150 investors over the last 4 weeks. We've grown that to that level. But as you could imagine, you have to hit about a certain level to be exponential. And again, it's been a month now. We got 150. We're growing every day. Site traffic is picking up every day. But again, we've only been around for a month or so. So I think I could answer that question better in our next podcast, maybe in 6 months or a year.
Right.
But it's definitely picked up a lot of traction. I mean, sponsors are actually reaching to us now. So with the sponsors comes investors. So
Right. Well, let's talk about that then. So the sponsors that are reaching out to you, right? What sort of sponsors are they? Because it sounds to me like this isn't going to be like some newbie that's never done a deal before is going to suddenly reach out to you and say, "Hey, I want to get on your website because
Yeah.
I want to buy like a 10plex." This is not like that, right?
No, no. This has to be a seasoned syndicator that's done a few syndications in the past. It can't be someone that's, for example, a broker that wants to get into the syndication business, wants to test out the market, so wants to do a 10-unit deal. The smallest deal we've done so far is 144 units.
Right.
And they've all had syndication background and syndicators, and so yes, it's not for someone that wants to do it for the first time. Although I mean that's something a lot of different platforms are looking into doing. Is, for example, let's say you want to do a 10-unit with a few people you don't know, let's say, and you could do that, but it's very difficult because of these regulations.
Oh,
Because it
100%.
was very easy. Like, you want to do a flip a house, you go, well, I don't know, I don't have any family members that are going to help me out. Hey, let me put it on this site and let me see if I could raise money to flip a house. Well, you have to have certain platforms. You have to have a certain exemptions, and a lot of times those cost so much money that they say, it's not worth it for me to spend 15 grand or 6 months to getting these undergoing the regulations to be able to get investors to flip a house, for example.
Oh, easily. I mean, just to get the syndication paperwork
Yeah,
involved, the SEC. Yeah, you're talking about $15,000
exactly. Yeah.
on the cheap side to get that done. So absolutely. I mean, not that I was trying to berate anybody with my question earlier. It's just that for smaller deals, especially for people getting started, I truly believe that you need to convince your friends and family to get into that deal first with you before you just throw it out to some website, because that involves a whole new set of problems or I shouldn't
Oh,
say problems,
absolutely.
challenges, challenges.
Absolutely. And then the other thing that sometimes, you could do it through a crowdfunding portal, but honestly, I just, you're right. It's not worth it. I mean,
Right.
for smaller deals, it's just not really. You end up you end up going through all this, and I've seen it. You go spend 15K, you list the deal, and then you don't get any interest. Now, not only you've lost 15K, you lost time. You could have spent that time vetting investors in your own community. So I mean, yeah, it's not a good idea for
No.
smaller deals like to do this. Yeah.
I think it gives people a false sense of security too for that investor. They just throw it up on the website, and then it's like, well, it's on the website, so people are going to be fun to get in no time.
Yeah, no.
It's
Oh,
not.
yeah. It's like, yeah, the psychology of, so that goes to the psychology of an investor, why they would invest, right? I mean, that's a whole science by itself, right? So you could have a lot of accredited investors, but hey, they don't want to invest. I mean, how are you going to get them to invest in a deal that you think it's a wonderful deal, it's a great deal, but why would they invest? And you have to get yourself inside that investor's mind. And some of the successful crowdfunding sites have done that, right? I mean, if you just put a bunch of Facebook ads out there and try to solicit investors, well, you know what? It has to be part of your funnel. You have to eventually kind of make it personal to them,
Yeah.
and that's fine as long as it's part of your funnel of going from prospecting to eventually to be able to make that one-on-one connection with each investor. That would work. But just throwing out yeah, exactly, listing your deal on a site and hoping for that to close, it's very it's unattainable. So
Yeah, I think that for many people, especially the ones starting off anyway, you got to realize that when that money or when that person is putting that money into that deal, they're putting that money into you as an investor as well as the deal. So
exactly.
it's in both. It's for the team or for the individual raising the money too. So if there's no track record to refer to, and then you're gonna have a very hard time. So and that goes with any platform, not just not just yours, but for any platform, right? I would imagine that even the guys on Fundrise, I know you said that now they're doing more more fund and REIT
Yeah.
style sort of scenarios. But I think back before they were doing all the other stuff, like Crowd Street and what was the other one? Mogul Realty Mogul.
Realty Mogul. Those are the main three ones. I mean, there's many, but those are the
Those
really
are the big three.
yeah.
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 Yeah, they rely, or the people that use those platforms, they rely specifically on individuals, or the individuals are just as important as the deal itself, right? And if there's no background, you're gonna have a very hard time getting the deal done.
Absolutely. Yeah. I mean, it is. It is. It's just you. I mean, I think this. I mean, my advice would be for sponsors to put themselves in the shoes of the investors, and you're absolutely right. I think like video podcasts are so important, webinars. I mean, those things are so important to establishing that relationship with someone that hasn't invested with you in the past. Now, obviously, if they invested with you in the past, it becomes a lot easier because you have a track record. You've been successful. You've returned money to them, and they're gonna come back to you no problem. Given the climate is right, the economic climate is right, their financial climate, finances are right to go back into the deal. So exactly, it's the personal relationship that is very important, and that's why we provide those. Every deal we put on the site, we offer a video webinar which goes on the sponsor's deal page. A video podcast, and then based on the interest level of the investors, then we set up a live webinar, which I think those are really important parts of the deal flow process before the actual, you could get an investor to sign a contract with you.
Now, earlier you mentioned funnels. You mentioned some other terminology that people may or may not understand what that is. And just to fill some people in, using a funnel online is it's a fancy term to get people to go to a website or a landing page to eventually convince them to send them your email address, and then you can kick off a dialogue from there. And then at some point, you may get 100 of these contacts, of which a smaller amount may or may not actually do business with you or transact with you. It's a fancy word. Now, are you setting up those types of funnels as well? Then, are you assisting in that, or are you guys just staying away from that, just focusing on syndicators, helping syndicators better market their deals?
When you well, I mean, we are. So I'll go through it. Like, for example, let's say you list a deal with us. It goes. So you sign up to our site. You put the deal on, and then you set up a video podcast, which then we record that. Then those things are both on your deal page, and it's on our social media page and platforms. And then what we do is we do have marketing both through email blasts of our own investors and also through our social media platforms, and advertising through both social media and Google. So those are all the things we provide for the sponsors. And going through the funnel, as you said, yes, I mean, those are things that our marketing team designs. Again, I'm not an expert in the funnel, the marketing funnel, which our team members are, and they know how to set that up. And we're hoping to bring more potential investors to make the contact with you, pick up the phone or email you.
Nice. Man, that sounds great. I may even sign up for something like this, man.
I would love to. I would love to have you on board. Yeah, we love great people like yourself to be on board.
Sure. Excellent. So let's say, for instance, someone is listening in right now, and maybe they're a bigger syndicator, right? And they're thinking about making some changes about better marketing their deals. What sort of bulletproof advice would you have for someone like that?
Always, don't try to do the same thing over and over and expect different results, right? Always be open to new ideas, to new ways for people to help, to create a win-win situation for yourself and others. If you're set on one way, always, be able to open up to other ways to raise money, for example, from a sponsor standpoint, and be personable, like yourself, always smile, and, people would open, I think, one thing, as we go into the digital space more, and you have to make that connection, there's not going to be a warm handshake. There's going to be, the smile on video, people, the psychology of why would I invest with you if you don't have a smile or or have energy. So that's what I would say.
100%. I think that rule is safe for any economy, really. I mean,
Exactly.
People are investing in you. Yeah, I totally believe that.
Exactly.
All right, guys. Well, if you want to reach out to Kam, you can reach him via his website at parkplaceinvestment.com. Hope you got some insight on possibly how to market your next big deal. It's very, very exciting. Definitely check him out. Thanks for tuning in, and I'll see you in the next episode. Take care.
Thank you for listening. We hope you enjoyed the Bulletproof Cashflow podcast.